some seeing support for this market, and a lot of that support on the back of GDP prospects, and saying that they see it prompting a 10 to 15% rally into the year end. What are you calling for the Kenyan markets?
Well, thank you very much, Alishia. That's a good observation there, and even a good analysis of the market. We're looking at it, especially in terms of foreign investor participation on our market. That's one of the things that really supports our market, just as you've noted. And looking at it in terms of going forward, yes, there's a lot of positive sentiments, though we are seeing a lot of profit taking, especially among the retail investors, which is very significant. Though looking at it in terms of the support levels, as well as the positive corporate earnings and corporate announcements that are coming through, definitely that is a positive front, and hopefully we should be hitting 5,000 mark going forward.
Before we drill down into specific companies, let's look at the banking sector as a whole. Of course, we know it's highly correlated to GDP growth in the country, and they've not been entirely disappointing. KCB and Equity Bank setting a pretty positive tone. Is that pretty much what's been factored in for banks across the board in Kenya?
Well, definitely looking at the banking front, especially looking at the Kenyan segment of the market in terms of looking at it in terms of the region, looking at it in terms of their positioning, it seems the banks are still enjoying a very good break in terms of their performance, and notably the kind of double-digit performance that we are seeing. But I think a lot of that can be attributed to the environment that you're operating in as at now, the reduced interest rates from the government, as well as the increased lending, as well as the positive sentiments that you are seeing on most of the key sectors of the economy. And because of that, the banks being intermediaries, they're being able to take advantage of that in terms of financing some of these projects, and majorly because of that backdrop, you're seeing a lot of growth. And hopefully, as they structure their balance sheets, do the right issues, and position themselves for taking advantage of some of the markets like the mortgage market, definitely going forward, some of these banks are poised to continue performing well.
Yet, Standard Chartered Bank disappointing the markets yesterday. Now, we did see a 19% rise in pre-tax profit on that end, and some markets would consider that pretty impressive. Run us through why the market was disappointed, because the question I'm asking is whether there was too much over-exuberance having been priced in at the start.
Thank you very much. That's a good observation about Standard Chartered. But while looking at it from a historical point of view, Standard Chartered has been a very conservative bank in terms of expansion, in terms of lending. And when you see that they have been able to do 19% against the backdrop of an increased lending in terms of their loan book, that is some sort of a positive sentiment. But looking at it in terms of the market perception, definitely it was negative in terms of how we saw the share price dip. And looking at it in terms of their structuring, as well as their most recent rights issue, it seems a lot of investors had a lot of positive sentiments about Standard Chartered, and looking at it going forward, well, they have quite a bit to do, and most of the people are looking at it in terms of the acquisition of the custodial service from Barclays as one of the things that has ate into their bottom line. And hopefully, as we close towards the end of the year, and even what they announced in terms of the interim dividend, definitely it will make their shareholders a bit impressed.
We've had this counter already posting a roughly, 107% one-year return. Just how much room is there to run on that share price in your books?
Well, looking at it in terms of their share price as well as their rise, just as you noted, yes, the rally has been very significant. But one of the things that really affects Standard Chartered is the fact that the number of issued share capital in the market seems to be a bit limited. And their strong dividend earnings as well as dividend payout is one of the things that creates a lot of interest in the stock. And being a global company, it's one of the counters which most of the foreign investors sometimes tend to be very interested in. And because of that demand pressure, which tends to create a bit of a demand-supply imbalance, we might see the stock being supported within those ranges. But in terms of buying right now, it's still a bit of a concern, because we hoped that the rights issue would create a bit of more liquidity in terms of the stock, but it seems that still is yet to be felt in the market. And hopefully going forward, we are going to see a bit of more activity on the stock and a bit of more of a correction in terms of the share price.
Let's put Cooperative Bank up against the likes of a Standard Chartered, where it's now posted close enough to a 150% one-year return. I mean, how are you viewing that counter right now? Is there room to maneuver within that space, and is there more upside on that price?
Well, looking at Cooperative Bank on the other front is that Coop Bank, basically looking at their positioning as at now, especially in terms of their background, the structure that they have in terms of the cooperative movement, they are very well positioned in terms of growth as well as in terms of expansion, because they're already talking about venturing into other markets of the region. And looking at them in terms of their performance, yes, there's still a bit of room for growth, only that as at now the price, I can say, is a bit on the higher end, and hopefully they're going to still be able to do well in terms of their dividend payout as we go towards the close of the year.
Of course, a lot of focus on the big caps, Samuel. Mid-tier banks versus big caps. I mean, what's the state of things in that regard as you see it? Because the mid caps don't seem to be very active right now, where they drifting lower, trading flat. No real upward momentum being witnessed on any of those stocks at the moment.
Well, definitely, yes. There seems to be a lot of focus on some of these large cap stocks, and basically, I guess the challenge on the mid cap companies as at now is well looking at their capital positioning in terms of their lending loan book, and some of these other concerns seems to be making them to be looking now more of a bit of the bucket in terms of how they are aggressive in terms of either the corporate earnings as well as some of the things that are coming to the fore, and hopefully some of those mid cap will take up the challenge, especially from some of these large cap stocks, and be able to be a bit more active. I think one of the things that's creating a lot of interest and a lot of activity on the market is some of these corporate earnings that are coming through, some of the bond issues and such kind of things that are creating a lot of interest and making some of these investors tend to shy away from these other stocks that are not as active.